Let's dive deeper into the concept of risk and return in this video. Have you ever wondered what really drives the world of investing? It's all come down to two powerful inspreadable forces, risk and return. What does risk mean? Risk means the chance that the actual result of an investment will be different from what was expected. It is the uncertainty of earning profit or even losing money. On the other hand, return is the reward for taking that risk. It is the gains or loss generated from an investment over time, often shown as a percentage of money invested. So the key idea is simple. Higher risk come with higher potential return, but also higher chances of loss. So where does risk actually come from? It's break down to two main sources. The first one is systematic risk, commonly referred to in finance as undiversified or market risk. It affects the entire economy or market, for example, like inflation, interest rate changes, political instability, or natural disaster. The second is unsystematic risk or specific risk, which affect only one company or industry. For example, poor management, shift in consumer preferences, or strike can cause a company's stock price to fall. Which risk can reduce by diversification? Systematic risk or unsystematic risk? The answer is unsystematic risk is the one you can reduce by diversification. This is the risk that only affects one company or industry. By investing in many different companies, if one fails, the other can balance it out. This is why spreading your investment helps lower your risk. Have you ever wondered why a savings account pays you less, while the stock market can make you thousands? This is because it comes from one of the most fundamental rules of finance, which is known as the risk and return trade-off. Let's think of this. Potential reward is always balanced by potential risk. This is a financial version of the no pain, no gain. Low-risk investment, like saving account or government bond, are like a walk in the park. They are safe, predictable, and comfortable, but your money grows very slowly. How about what is the trade-off? The trade-off is a peace of mind for a smaller reward. Now, high-risk investment like stock or crypto are like climbing a mountain. The view from the top, the potential for high return is incredible, but the path is volatile and unpredictable. How about what is the trade-off? The trade-off is the chance for the big reward come with the very possibility of significant loss. So the goal isn't to avoid risk altogether, it is to understand it. Your job as an investor is to find your balance. Are you a risk taker or do you play it safe? When we measure risk in finance, we are basically checking how much an investment return can change or fluctuate. First tool is standard deviation. It tells us how much the actual return moves away from the expected return. If the return jumps up and down a lot, the standard deviation is high, meaning that the investment is riskier. The second tool is beta. Beta measures how sensitive an investment is to the overall market. If beta is lower than 1, it means that it's lower risk. And if it's greater than 1, it means that the risk is higher. We also use scenario analysis, looking at best case, normal case, and the worst case to see how the investment might perform in different situations. For example, there are two companies. The first company is GYB, which is an established car company. And the second company is Jesse Chains, which is a startup supermarket chain. GYB has been selling vehicles for 20 years. Its revenue is predictable and leading to a stable stock price, so it leads to a low standard deviation and lower risk. Jesse Chain is a new supermarket opened its first 15 stores. Its future is unproven, causing a volatile stock price. It leads to high standard deviation and higher risk. GYB has a beta of 0.8, so if the market drops 11%, it might only drop 8%. It is less sensitive than the market. Jesse Chain has a beta of 1.7. So if the market drops 11%, the stock might drop 17%. It is more risky than the market. In simple terms, the more return fluctuates, the higher the risk. In summary, the fundamental rule of investing is the direct trade-off between risk and return. To navigate this, you must align your choices with your personal risk tolerance and long-term goal. There is no single best investment, only the one that is best for you. Thank you for participating in our risk and return training session.